Hello, welcome to my channel. In this video, we are coming to do something very important in accounting. We are going back to the basics. Now, as some of you already demanded that I do a video that looks at how to automate your ledger accounting system and then extract a trial balance and also prepare a full set of financial statements. And so that is what we are coming to do in this particular video. We are coming to learn how to prepare, that is number one, prepare a full set of ledger accounts based on a number of transactions that occur within a particular period. We are going to balance off those accounts and extract a trial balance. And then we are going to use that trial balance to prepare a full set of financial statements. So we've got a lot to cover in this video. So thank you very much for tuning into my channel. If this is your first time on my channel, please subscribe to the channel and also don't forget to like the video if you find it useful, and don't forget to share and leave your comment in the comment section down below. All right, so I'll be very much excited to hear from you after watching this particular video. So this is what we've got. So to be able to understand whatever we are coming to learn in this video, there is a need for us to understand certain fundamental accounting concepts. All right. Now, what is accounting? Accounting, as we all know, is the art. It's an art, okay? It's the art or a system of recording. So first of all, you need to recognize a transaction. You measure. After measuring, you record. After recording, you summarize. After summarizing, then you are going to communicate these particular information to management for decision making. And accounting is, for companies, it is a statutory requirement. All right, so it is required by law to have a system of accounting in your business function. All right, so gaining an accounting knowledge is as important as any knowledge that you might need for the smooth running of your business. And then knowing how to automate these particular accounting processes in a tool such as Microsoft Excel is such invaluable for you. So let's look at how we are going to do that in this particular video. All right. So having said that, we want to look at one fundamental accounting concept, and that is what we call basic accounting equation. The basic accounting equation, which we have here. Now, what is the accounting equation? It is as simple as ABC. On the face value, that is how simple it is, but until you get into it, before you realize that it is not actually like that. So we have the basic accounting equation to be assets equal to equity plus liability. Now, equity can also be referred to as capital. All right, so we have assets being equity plus liabilities. That is the accounting equation. Now, each of these elements is what makes up the entire business. All right, so the elements we are seeing in this equation here all have their meanings, and then they have their classifications and all that. So first of all, let's look at assets. In its simplest definition, we can say that assets are all the properties and everything you own. The key word here is own. So everything you own, and then accountants, we add another term called control. All right, so anything you own or control becomes your asset. All right, that becomes your asset. Then we are saying that this asset which is everything you own and control, is equal to the equity. Now, before I explain equity, let's look at liabilities. Okay, so we say that assets are everything you own. Okay, then liability is the opposite of assets. So the liabilities are talking about everything you owe. All right, everything you owe is what we call the liabilities. So we are talking about an obligation you have to fulfill to an outside party of the business. That is what we call a liability. All right. So this is just the basic definitions I'm giving you. All right. Going into the accounting itself, but that is not the purpose for this particular video. So we are not going to enter into the technical definitions. All right. But this is the technical definition is telling us that assets are basically what you own and or control, and the liabilities are talking about what you owe. All right, everything you owe. Then the equity is talking about there are various ways of defining your equity. You can say that your equity is actually your assets minus your liability. So when you take everything you own and you subtract everything you owe, the residual value becomes your equity. Or we can say that your equity is actually the contributions made by the owners of the business. That is another definition which is acceptable. So your equity is the contribution made by the business owner. All right. So if it is a company, by the shareholders. If it is a partnership, then by the partners. If it is by a sole proprietorship, then that is the contributions made by the owner or the startup capital of the owner. That is what we call equity. That is why we call equity as capital. So you can call equity too as capital. Now, this particular basic accounting equation forms the fundamental for everything we do in accounting. Okay, so when it comes to accounting, everything we do actually is based on this particular basic accounting equation, as you can see here. So I'm introducing you to this because it's going to be relevant for whatever we are coming to do in the rest of the video. All right, now our focus for now is how to understand the accounts and then the ledgers. All right. Now, what is an account? An accounting is just a historical record of a transaction. That is an account. So when you record your transaction, we call it an accounting account. All right. And now, recording transactions within an account actually has rules. Now, what is first of all, let's talk about the structure of an account. What you are seeing here is what we call the structure of the account. So we have the name of the account at the top, presented horizontally. Then you rule a line under the name of the account, as you can see there. And then you have another vertical line crossing the horizontal line. And then these will in turn form a T. It will look like a T account, as you can see here. So this is the horizontal line together with the vertical line forming a T. Now, the left side of this T account is what we call the debit side, which we can also shorten as DR. All right, so it is uppercase D and then lowercase r, like that. And then the right side of the T account is what we call in accounting credit side. And this credit side is often shortened as CR. Now, this is what we call convention. Okay, it has become a convention in accounting. it has come to stay. It's a practice that is generally accepted. So when you see CR in accounting, we call it credit. When you see DR, we call it debit. All right, so take note of that. Now, let's talk about the rules. Now, these rules are what we call the double entry principle. The double entry principle. All right. Now, this double entry principle states that um, for every transaction of a business, there is a debit entry and there is a corresponding credit entry. So I'll come again. The double entry principle in accounting states that for every debit entry you make, there is a corresponding credit entry. Now, whenever we understood the structure of the accounts, we say that the left side is called the debit side, and then the right side is called the credit side. Now, whenever you put an item at the debit side of the account, we are calling it debit entry. Whenever you put or you record an item at the right side of the account, we call it a credit entry because it is at the credit side. All right. Now, putting the items at the debit side and the credit side have rules, and then we call these rules the double entry rules. All right, the double entry rules. And the double entry rules, you'll be hearing things like debit this, credit that, debit this, credit that. Now, to understand the double entry rule, you need to understand what we call the duality principle. All right, so we have what we call the duality principle, and the duality principle tells us that for every transaction there are two sides. Okay, there are two sides to every transaction in accounting. And why is it so? It is based on the accounting equation. When you see the accounting equation, you see that we have assets at one side, which we have here. Then we have an equal, and then we have equity plus liabilities on the other side. So this is what the duality principle is based on. All right. So you have an asset and then equity plus liability. So for every transaction, there is an asset side and there is an equity plus liability side. That's what we are seeing. All right. So understanding that, we can now talk about the rules for recording the transactions. Now, because we understood assets, equity, and liabilities, let's see how we are going to put them within the account system. So, what we are saying is that the rule is that whenever assets increase, whenever the assets of your business increases, then you are going to put it at the debit side of the account. And so it's going to have a debit entry. So increases in assets have debit entries. All right. And then increases in liabilities have a credit entry. Now, why is it so? Let me try and explain. We are saying that our accounting equation is equal to assets equals um sorry. So we are saying that, let me just correct this. Okay, so we are saying that our assets should be equal to our equity plus our liabilities. Is that not so? Now, this particular equation is what we divided into the accounting equation. So let me insert my borders here. So I have a border, down border there. And then I can put my vertical border here as well. So I'll come here and then insert my right border there. Okay, so this is what we are saying. So let me actually come here and put another border here. Okay. So this is what we divided to form the T account, as you can see here. All right. So what we are saying is that the assets, because the assets fall at the left side of the account, which we have come to understand as the debit side of the account, any increase in the assets is going to be put here. All right, it's going to be put at the asset column, as you can see here, and that is the left side of the account. Then any increase in equity and liabilities, or capital and liabilities, is also going to be put at the right side of the account, as you can see there. All right, that is the reason why increases in assets are debited and increases in liabilities and equity are credited. All right. So when you have a transaction and that transaction is an asset transaction, there is an asset element in that transaction. That asset and that asset is increasing the value. All right. We are talking about the value. The value of that asset is increasing. We are going to put it at the left side of the T account, which is the debit side. And whenever there is an equity or a liability component in that transaction, and the transaction, the equity or the liabilities is increasing in that transaction, then you are going to credit it, and that is put it at the right side of the T account. So that is the basics. You need to understand their rules, and so you have to memorize them. All right, you have to learn and memorize them as well. But I just want to give you more understanding so that you don't just memorize, but you also understand whatever you are memorizing. All right. So this is just an explanation I'm giving you. Now, transactions do not only involve assets, equity, and liabilities, they also involve expenses, income, losses, and gains. All right. So what you're saying is that expenses, whenever they increase, are also debited. All right. Whenever expenses increase, they are debited. Take note of that. And whenever income increases, it is credited. Whenever income increases, we credit it. That is, we record it at the credit side of the T account. All right. When we get to the questions, if you are new to these concepts, when you get to the questions, you understand even more. All right. If you are already familiar with these particular principles of accounting, then feel free to skip this part of the video, and then we can continue from wherever you are um, comfortable with. All right. Now, why do we have to debit expenses whenever they are increasing? Let me try to explain. Now, what the assumption or the fundamental reality is that expenses increase the um the performance or the value of your assets. All right. Whenever you incur expenses, that expenses those expenses, they go a long way to increase the efficiency, the performance, the value of your assets. That is why they are moving with your assets. All right. Then income also increases your equity. Whenever you have income or revenue, revenue is actually part of your income. All right. So whenever you have an income, it is increasing your equity. Therefore, it is moving with your equity. So any increase in your income is going to be credited, just as we credit increases in equity as well. All right. So that is it. Now, the opposite is true for decreases in these items. So whenever there is a decrease in assets, you are going to credit them. So as you said, whenever there is an asset increase, we are debiting it. So when they decrease, we are going to credit. The same applies to our expenses as well. Then decreases in any of these items are also going to be credited. All right. So whenever your liabilities decrease, you are going to credit. Sorry, you are going to debit. whenever your equity decreases, you are going to debit. So that is the double entry principle. So let me try and summarize whatever I just said. So whenever your assets and your expenses are increasing in a particular transaction, you are going to put the value of that transaction in the debit side of the account. Whenever your liabilities, equity, or income in a particular transaction are increasing, you are going to record it at the credit side of the account you are going to open. All right. Then the opposite is true for these items. Whenever your assets and your expenses within a particular transaction are decreasing, you are going to credit them. And whenever your liabilities and your equity or income are decreasing in a particular transaction, you are going to debit. All right, so this is the fundamental knowledge of accounting. So a lot of people, whenever they hear debit and credit, then they become confused. All right, but in this particular video, I'm taking my time to explain it to you so that you know exactly what we mean by debits and credits. Now that we have understood debits and credits and what items are debited and what items are credited and the reason behind them, let us look at the concept called ledger. So we have ledger. Now, what is the ledger? A ledger is just a collection of accounts. A ledger is simply a collection of accounts, and it is the final resting place of our accounting transactions, of our accounting records. All right, it's the final resting place for those records. So there are different types of ledgers in accounting, and there are three main types of ledgers. All right, so we have the main or the general. It has three names. So we have the main or the general or the nominal ledger. Then the second one is the receivables. So we have our receivables ledger. And then finally we have our payables ledger. All right. So I have explained ledger. So what are the types of ledgers? So to explain the main or the general or the nominal ledger, let's first understand these two, and then we'll know what exactly the general ledger is. So the receivables ledger. The receivable ledger contains the accounts of the individual debtors of the business. It contains the accounts, the individual accounts of the debtors of the business. All right. So whoever owes the business is going to be recorded in this particular ledger called receivables ledger. So there are amounts that we are expecting to receive within the next financial year. All right. So that is the receivables ledger. Then the payables ledger is the opposite of the receivable. So that one contains the accounts, the individual accounts of all suppliers of the business. All right, so that is the payables ledger. So whenever the business purchases goods on credit from from businesses outside, then those transactions are going to be recorded in our payables ledger. Whenever the business sells goods on credit to customers, then those transactions are going to be recorded within the receivables ledger. Now, the main or the general or the nominal ledger contains items that do not fall under these two. All right, so any other transaction that do not fall under receivables, that is credit sales, and payables, that is credit purchases, are recorded under the main or the general or the nominal ledger. So we are talking about assets accounts, non-current assets account, current asset accounts, or other current like cash, cash book and all that, they are all recorded under the general ledger. So this is just something I want you to understand before we dive into the business for today. All right, so this is just a brief overview of whatever we call the accounting basics. All right, so that is it. So let's continue to our business for today. So having understood the basics of debit and credit, let us now put this knowledge into practice. All right, and then your understanding will be well enhanced. I hope so. All right, so we have some transactions for Donald. So we are saying that Donald sets up a trading business, buying and selling goods. The following transactions occurred during his first month of trading. So we have the transaction number, and then we have the details of the transaction. Now, an alternative way or a better way of presenting this information is actually, instead of having a transaction number, you could actually have the transaction date. All right, we know in accounting we work with dates. Date is so important in accounting, so we don't joke with our dating system. All right, so that is just a tip. So instead of seeing transaction numbers, you might as well see transaction dates. So wherever we are going to put the transaction number in the account, you are going to, if it is a date, you are going to replace it with the date. All right, so let's look at our transactions. Let's read through quickly so that we can understand whatever we are doing there. All right, so the first transaction, Donald introduced 50,000 into the business by paying money into a business bank account. All right. The business bought a motor van for 6,000. Payment was made by check. Okay. The business bought some inventory for 3,000, paying by check. All the inventory purchased in transaction 3 was sold for 5,000 in cash. Okay, so transaction 5 says more inventory was purchased for 10,000. The purchase was on credit. All right. 50% of the inventory purchased in transaction 5 was sold for $8,000. All these sales were on credit. Okay, so we have a payment of 3,000 was made to a supplier for some of the purchases. All right. Then we also have Donald um Donald drew $1,000 from the bank account for his personal use. Donald paid 200 for diesel for the motor van. The business paid 1,500 by check for the premium on insurance policy. And then finally, which is transaction 12, the business received a bank loan of 10,000 repayable in 2 years. Record these transactions in the main ledger accounts of the business using the following format. So we are to use the format here, and this is the format of the account. All right, as we have previously seen. Now, the only thing is that we have a transaction number, we have the name of the account containing the matching double entry, and then we have the amount column. And then same thing up is applied to the credit side as well. So we have the transaction number, we have the name of the account containing the matching double entry, and then we have the amount. All right. So since you have looked at our question, let us look at how we are going to do this and also apply some automation techniques. So first of all, what you have to do is to give it a nice heading here. So we can say in the books of Donald at the top there. Okay, so let me actually cut this and then paste it here. Sorry. So I'm going to cut that and paste here. Okay. Sorry. So this is actually let me put it here. All right. So we are going to create our account. So we have been given the format of the account. So quickly, as we know, it looks like a T. So what I'll do is that I'm going to just select a couple of cells here, and I'm going to insert a border, bottom border. Now you can just come here and then click here, or you can use your shortcut key to do that. So I'm going to teach you how to use shortcut in Microsoft Excel. So to use the shortcut, you can just hit your Alt tab, sorry, your Alt key on the keyboard, and that is going to give you these controls. All right, the controls within your the various tabs. So to access your home, we know that the border is on the home tab. All right, so and the home tab is denoted with the letter H. So I'll hit my H on the keyboard, and that will open the various menus for me on the home tab. Now I want border, and we know that border has been assigned this particular value called B. So I'll just hit B on my keyboard, and that will open the borders menu for me. And now I want to insert a border to the right of the selected cells. So what do I do? I'll just come here and relocate my right border. So I'll hit R, and that is going to insert my border for me. As simple as that. All right, so I want to extend this border a little. So this is what we have. All right, so that is how you create a T account within your accounting system. All right, so we have our three sections here. We have our three sections here, and then what I'll do is to duplicate this particular item here. Okay, so I'll just come here and then I'll copy, and I'm gonna move 1, 2, 3, and then I'm going to paste there. I'll come down here and paste the same thing here, come down here, and I'm going to repeat it for a number of times. Okay, so we have that. I'll come here. So to leave, you don't know the number of transactions that are going to enter into each account. So what you can do is that so before we even continue that, I want to change this a little. So let's input our narrations. So I'll come here and then I'll have narration. I'll have narration, and then I'm going to insert my dollar sign here. That is the amount column. All right, so I'll come here and then I can copy this. Okay, so I'll just come here and then do same. So I have my narration, and then I'm going to insert my dollar sign here as well, so that I can now copy this. And then what I want to do is to extend this a little, because I don't know the transactions, the number of transactions that are going to into each of the accounts. So I'll just have there, and then I'll copy this, and I'm going to paste as I did previously. All right, so I'll come here and then I'm gonna paste here as well, come here and paste here as well, come down and paste, come down and paste. I'll also come down and paste here, come down, paste, and then let me do a last two here. So I've come here and then I'll also paste it. All right, now the final thing I want to do is to format the amount column. So holding my, so I can just double click any cell to be able to remove that highlight border there. So what I want to do is to format my amount columns so that they are amounts. All right, so I'll come here and then I'll select these parts. I'll come here and select this. So holding control, I can just hold control and then select each of the columns I want to select. All right, so I was holding control before I was able to achieve this. So what I'll do is come to my this place, and then I'll select my corner, my comma there, and then I want to reduce the decimal places to 0. So I'm going to, the default is 2 decimal places. So I'm going to press this and click this twice to be able to remove those 2 decimal numbers. So I'll just click here 1 and 2. So that is what I want, and so I've gotten that. And then I can expand the column also a little. Let me expand these columns a little, and then I can also expand my transactions column also a little. All right, so I'm just expanding my narration columns a little so that they can accommodate the names of the corresponding accounts we are going to enter in there. All right, so this is how you set up your accounts. And then let me also cut this again and put it somewhere at the middle here. Okay, so we have that nicely. Now we are going to pick each of the transactions and apply the principles we have learned previously into recording the transactions. So I'll come here. Transaction 1 is saying Donald introduced 50,000 into the business by paying money into a bank account. All right. So um, from our understanding of equity, assets, and liabilities, we can understand from this particular transaction that this is what we call equity, because this is the amount the owner, which is Donald, is introducing into the business. So it becomes equity, or what we call capital. All right. Now, going by the duality concept, we are seeing that every transaction has two sides. So if you read a particular transaction in accounting, you should know that that account affects two, that transaction affects two accounts. All right, it's always affect two accounts. So when you read a transaction, you should be able to analyze it and identify those two accounts that are being affected within the transaction. So we have identified one to be capital or equity accounts. All right. Now they have paid this, the owner has paid this into the business's bank account. Therefore, another account is called bank account. You rightly got that. All right. So that is the bank account. So the two transactions, sorry. So the two accounts affected within this particular transaction is the equity and then the bank accounts. All right, I hope you understood this. You are going to continue and then you are going to get it even more. So, going by that, I will come here and then I'm going to have what we call equity. Now, as I said, equity is also known as capital. So, in some books, you will see capital. Don't be confused. All right, so I can just merge and center that. So we have equity, and then the next account is what we call bank. Now you can write the full name bank account, but for simplicity's sake, okay, so let me just add account here for you. The rest of the transactions, I'm not going to add accounts. You can choose to add it. All right. So we have equity account and then a bank account. So how are you going to record that? We'll have our transaction number as we have seen in the structure. So we are saying that now we are coming to apply the rules of double entry. Okay, now the business owner has introduced capital, which means our capital or our equity has increased. And from the rules of double entry, what did we say happens to equity being increased? We credit it, as we can see here. So increase in these items are credited. Increases in liabilities, equity, and income are credited. Therefore, if we introduce money into the business, then we have to credit it into the capital or the equity account. So quickly, I'll come here and then I'll have my transaction number 1 there, and then the narration here is going to contain the accounts that is going to contain the corresponding entry. That is the double entry principle. So for every transaction, or for for every transaction, there is a debit entry and then there is a corresponding credit entry. All right, that is a principle. So this narration column here is going to contain the account that is going to have the corresponding entry. And from our analysis, we got to know that the corresponding account is going to be our bank, because the amount introduced into the business is going to be put in the bank account. All right. So how much is it? It's 50,000. So I can write my 50,000 there. Since we have formatted this, it has formatted it correctly for us, and that is fine. All right. Now, this has been recorded at the credit side. Therefore, the corresponding entry is going to be debited. So, and we know that the corresponding entry is going into the bank account. So that is how you do it. All right. So I'll come here. This is my bank account. I'll come here to the debit side. This has been credited. And so the corresponding entry is going to be debited. That is one way of analyzing it. Another way is we are putting money into our bank account, which is an asset. All right. So since the bank account is an asset containing money, increase in it is going to be debited. That is where you are debiting it. So I'll come here and then I'm going to have my 1 there, and then the narration here is going to be the account containing the corresponding entry, which is our equity account. I hope you are getting the dynamics now. So when we came here, when we were recording here, the corresponding entry was going to the bank account. Therefore, we wrote bank here. When you come here, the corresponding entry is going into the equity account. Therefore, we will have equity here. You got it right. Then the amount is going to be 50,000. So I can come here and reference the 50,000 right there. Okay, I hope you understand that. So that is the first transaction for you. Now let's continue. The second transaction is saying that the business bought a motor van for 6,000. Payment was made by check. Good. So transaction 2, the business bought a motor van for $6,000. Payment was made by check. All right. So analyzing this particular transaction, let us identify the two accounts that are going to be affected, or the two accounts involved. All right. When I talk about accounts, I'm talking about whether it is an asset account, liability account, an expense account, and all that. All right. So the items involved here are motor van, and we are paying by check. Therefore, we are talking about our bank accounts. All right. So whenever a transaction involves the use of check, then we are referring to our bank account. Therefore, the accounts involved here are motor van and check, or the bank account. Now, I want you to understand this before we continue. This motor van here is an asset, but it's not just any kind of asset. It is what we call non-current asset, or the long-term asset. There are two types of assets. We have current assets and then the non-current assets. The current assets are those assets that are going to be consumed or used up within one financial year. All right. Then the non-current assets are those that are going to be used in the business, but they will not be consumed within one accounting period. So they will be used for more than one accounting period. All right. So that is what we call the non-current assets. Now, this motor van here is going to be used by the business. It's not an item that we have bought in order to sell, but we have bought it for use in a business. All right. So we are going to create an account. What we do is that we create account for non-current assets. We create separate account for non-current assets. Now, the same logic applies to liabilities. We have non-current liabilities and current liabilities. And the non-current liabilities are expected to be repayable in more than one financial period or financial year. All right. And then the current ones are expected to be settled within one financial year. So what we do is that for the non-current items, we open accounts in the name of those items. Therefore, here the business bought a motor van of 6,000. Therefore, the motor van account is going to be opened, and then a bank account is also going to be opened. All right. But fortunately for us, we have already opened a bank account. Therefore, we are just going to open a motor van account right here. So I'll come here and then I'll have motor van. Okay, and then I can merge and center that. Okay, now an alternative for merge and center is also to um, um, distribute across selection. That is actually a better way of doing it. Why? Because in Excel, when in case I want to adjust these particular columns, is going to be interfering with other columns within the account. Therefore, we usually make use of merge or we say distribute across selection. And how do we do that? I've undone my merge and center. So I'll just click Control 1, and that is going to open this format cells for me. And what I'll do is to go to my alignment here, and then for the horizontal text alignment, I'll come here and then I'll say center across selection. Center across selection. I'll select that and then I'll hit OK. So you see that it has centered my transaction for me, but I can adjust the individual columns right there. All right. So that is a better way of presenting this. So I can just unselect this and I'll hit Control 1, come to my alignment, horizontal, and then I'll select center across selection and then I'll hit OK. So that is just another bonus tip for you. Another way of assessing the alignment is to come to this particular arrow here and click that, and then to take you to your alignment or the format cells pane, and then you can do your selection and hit OK. All right, so that is just by the way. So we have our motor van account and then our bank accounts. So let's go back to the transaction and see what is happening there. So the business bought a motor van, therefore our motor van has increased. The motor van is an asset, remember? So increases in assets are debited. So I'll come here and write my number 2 at the debit side, and then the corresponding entry is going into my bank account. Therefore, I'll write bank here, and then the amount involved is $6,000. As simple as that. And then I'll go to my bank account. In this case, we have debited our motor van. Therefore, the corresponding entry is going to be credited. And that should explain the fact that it is not always that the transaction affects an asset and affects a liability. Sometimes it can affect an asset only. All right. And when that happens, it means one asset is increasing and then the other is reducing. So that at the end of the day, what we are trying to achieve is that we want to ensure that the equation is always satisfying. Asset is always equal to equity plus liabilities. All right. Your asset must always be equal to, so when asset has increased and another asset has decreased, the effect is going to be zero. Therefore, the asset will always be equal to our equity plus liabilities. And then similarly, if our assets have increased, then our equity and liabilities should have also increased. If the assets have reduced, then equity plus liabilities must also reduce, so that at any point in time, the equation is being satisfied. All right, so that is what we are trying to achieve here. So in this particular transaction, these are two assets, our motor van and then our bank accounts, which are both assets. But in this case, the motor van has increased, but our bank account has reduced, so that at the end of the day, our assets is still equal to our equity plus liabilities. That is another tip for you, bonus. So we'll have my two here, and my corresponding entry was in the motor van account. So I write motor van there, and the amount I'm going to reference this. The reason I'm referencing is for the automation. All right, so that any changes I make to this particular figure here is going to reflect in the corresponding figure right here. All right, so that is the reason why I'm doing the referencing for the amount columns. Okay, now let's go to transaction 3. We have the business bought some inventory for $3,000 paying by check. So here the business has bought an asset, and in this case it is inventory. Okay, so that is the reason why I explained the current and then the non-current assets. Now we know that inventory is an asset. Inventories and assets, but inventories are going to be consumed within one financial year. Okay, they are going to be consumed, or they are going to used up, or they are going to be sold within one financial year. Therefore, they are current assets. Therefore, when you buy inventory, we call it purchases. All right, whenever you buy inventories, we call it purchases. So in this case, you are going to open what we call, because we bought inventory, you are going to record it in purchases account, and then the corresponding entry, because you are paying by check, is going to be recorded in the bank account. And the inventory, because you bought inventory, the inventory has increased and is an asset, therefore it's going to be debited. The payment by check is going to affect our bank, and since cash is leaving, okay, since cash is leaving us, is reducing, is decreasing, we are going to credit our bank account. As simple as that. So I'll come here and open another account and name it purchases account, and name it purchases account. As I said, I'm not going to be adding the account, so let me do my formatting quickly. So center across selection, and then I'll hit OK. Okay, so the transaction is going to be recorded here at the debit side, because our inventory is increasing, the purchases has increased. Therefore, I'll have my 3. The narration is going to be bank, and the amount involved is how much? 3,000, I guess. So 3,000 there. So I'll come here and I'm going to write my 3,000. Then I'll come to my bank account. You have transaction 3 there, and the corresponding entry went into the purchases account. So I'll write my purchases under the narration column, and I'm going to have what we call the amount there, which I'll reference from my purchases account here. Okay, so to make this a little, let me bolden this using Control B. So I can just bolden this, Control B, and to repeat my whatever, I can just use F4. All right, I can use F4 to repeat the last transaction, so that I don't have to type control, or I don't have to click my Control B again. I just use F4 to repeat my last transactions, my last action. Sorry, so let me just cancel this. I'll use F4 to repeat my last action, F4 to repeat my last action, then F4 to repeat my last action. All right, so I'm just highlighting this so that they look a bit clearer. Okay, so that is it. And then also let me increase the font size a little. So I'll come to the top right corner here, and then I'm going to reduce this to increase it to 13. Now you might notice something, that my grid lines within my Excel worksheet have disappeared. So how did I do that? I intentionally do that. So how did I do that? I went into the view tab here, and you will see grid lines. So when I select my grid lines, when I click here, it's going to select my grid lines, and you are going to see my grid lines appearing again. All right, so as you can see them, so I have to turn it off by unselecting that, and then that is it. So that is how I turned off my grid lines. All right, okay, so let's continue. So we are going to record those transactions which we have already done. Okay, so let's continue. We go to transaction 4. All the inventory purchased, that is in transaction 3, was sold for 5,000 in cash. All right, so let's analyze the transaction. So you are saying that the inventory we purchased in transaction 3 have been sold for 5,000. That means they were sold at a profit of 2,000, but we are not interested in profit elements and all that. Okay, we are just recording the transactions at the amount that is being stated in the transaction. So in this case, we are going to use the 5,000. All right, so all the inventory purchased were sold for 5,000. So what we do is that the when we bought inventory, we say they are going to record it in purchases account. Therefore, the opposite is true for sales account. So here the inventories have been sold. Therefore, we are going to have a sales account, and the corresponding entry is not going into the bank account anymore. It's going to be recorded in cash account. All right. Now, usually what we do is that we open what we call a cash book. All right. So instead of having a separate bank account and a separate cash account, you have what we call the cash book. Now, the cash book, you usually have three columns. We have one column for discount, one column for the bank, and then one column for the cash. All right. So that is another way of presenting your bank, or in fact, that is actually the best way of presenting your cash and then your bank transactions. All right. So you will have a bank column and a cash column, and we call this the two-column cash book. If you are interested in knowing more about the two-column cash book, make sure to leave your comments in the comment section, so I can make a video on the two-column or the cash book on its own. Now the cash book is a very special ledger. Now I am calling the cash book a ledger. Meanwhile, it is also an account. So the cash book is actually special because it serves as an account as well as a ledger. All right. So it is the book in which we record our cash and bank transactions, and it also serves as a ledger on its own. All right. It serves as a ledger on its own. So the cash book is a special book. If you're interested in knowing more about the cash book, make sure to leave the comments in the comment section. All right. So let's continue. So I'm going to open a new account here called cash account. So I have my cash account there. Okay. Then I'm going to my home tab, and then I'm going to merge and center that. So I'll just come here, horizontal, center across, and hit OK. And the next item that is going to be affected is our sales account, because this one we have sold inventory. All right, we have sold inventory. So I'll just come here, and let me see if F4 will work. So hitting F4 is going to repeat my last transaction, my last action in Excel for me, and that is fine. So in this case, our cash has increased. It's an asset. Cash is an asset. All right. So it has increased because we have sold our goods and received cash. So the cash has increased and then our inventory has reduced. Therefore, we are going to debit our cash, which is an asset and it is increasing. And then we are going to credit our sales account, which is actually an asset which is reducing. That is our inventory. All right, so I'll come here and I will have transaction 4, and the narration is going to be sales because the corresponding entry is going to our sales account, and then the amount involved is 5,000. I'll come to my sales. Since this has been debited, I'll come to the credit side of my sales account. Now, the sales account always has a credit balance, and sales is an income. All right, and as we rightly said from the beginning or from the rules, income increases in income is actually credited. All right, so our sales is an income, therefore if it increases then you are going to credit it. All right, that is how you analyze everything we are doing here. Okay, so I'll have my transaction 4, then I'm going to have the narration, which is going to be cash, and then the amount. I can reference it for my cash account here and hit OK. So that is that. Then we go to transaction 5. More inventory was purchased for 10,000. The purchase was on credit. Now we have purchased inventory, but in this case we have purchased it on credit. Therefore, we are going to record the purchase of inventory in our purchases account, all right, but the corresponding entry has changed. All right, from the transaction 3, we bought inventory but we paid by cash. This one, it is on credit. Therefore, this has given rise to what we call payables. All right, so we have bought inventories on credit and we are going to pay the supplier of the inventory. Therefore, this becomes a payable. So we are going to open a new account called payables account, and then the corresponding entry is going to our purchases account, which we already have. So quickly I'll come here and then I'm going to record this in the payables account. All right, and then I'm going to, so let me just use my merge and center for now, okay, to save time. So with my payables, what is happening here is that the payables, what is happening? More inventories were purchased for 10,000. Therefore, if we purchase inventory, we are going to debit our purchases account because the purchases or the inventory has increased. All right, they have increased and it's an asset. So increases in assets are debited. So I'll come here and then I'll write payables. All right, and then the amount involved is 10,000. Then the corresponding entry is going to be credited in the payables account. Now, payables are liabilities because you are going to pay the suppliers. So they are liabilities. Therefore, they are going to be credited. And it is increasing. All right. So we are going to credit it. So I'll have my 5 there. And then I'll have my purchases, which is the corresponding account right there, and I'm going to reference the amount from my purchases account, which is 10,000 right there. Okay, I hope you are getting whatever we are doing. So let me quickly format this, bolding those. Okay, let me quickly format everything here and bolding it. Let me select everything here and bolding. I can even select everything here as well So let me actually select from here and bolding. Okay, so we move on. Let's go to transaction 6. 50% of the inventory purchased in transaction 5. So 50% of the inventory purchased in transaction 5, which is going to be $5,000, was sold for 8,000. All these were on credit. All these sales were on credit. So this is the opposite of what happened in transaction 5. We bought on credit, so it was in the payables account. Now we are selling on credit. Therefore, it is going to be recorded in an account called receivables. All right, receivables. So we have receivables here. So we have our receivables right there. And let me merge and center that. Okay, so the same logic applies here. So 50%, which is so the 50% here is actually not something that we have to be concerned with, because we have been given the amount for the sales, and so we are more concerned about the amount for the sales rather than the amount of the inventory that was purchased. All right, so what's the amount involved is 8,000, and we have our receivables account, and what again is going to be a sales account, which we already have. Okay, so we have sold, so our sales is going to be increased. Therefore, I'll come here and write 6. We have sold inventory, therefore it's going to be increased, and the corresponding entry is going to be receivables. All right, and the amount involved is 8,000. Then I'll come to my receivables account. Since this has been credited, I'll come here and come and debit it under the receivables column. Now, the receivables are actually assets. Receivables are assets. They form part of our current assets. So if they are increasing, we are going to debit it. We are going to debit it. So I'll come here and then I will have transaction 6. The narration is going to be sales. It's going to be sales, and then the amount can be referenced from my sales account here as 8,000 right there. Okay, I hope we are following. So let's go to transaction 7. A payment of 3,000 was made to a supplier for some of the purchases. Payment of 3,000 was made to supplier for some of the purchases. So payment was made of 3,000 to the supplier, which means that where our suppliers recorded. They are recorded within the payables. This particular amount here is what we are calling the payables, and they are the amounts payable to our suppliers. And if we have paid them 3,000, it means this 10,000 has reduced by 3,000 or to 7,000. All right, that's the difference. So we have paid them, all right, which means we have paid them by either cash or bank. Cash or bank. But since most of the transactions here have occurred through the bank, we are going to assume that this payment was made through our bank accounts. Therefore, the corresponding entries are going to be our payables account, which you already have, and then the bank accounts. Now, the bank is an asset. It has reduced. We have taken money and we have paid our suppliers. Therefore, the bank account has reduced, and then the payables has also reduced. Okay, the payables has also reduced, and we know that the payables are expenses, and if expenses reduce, the payables are liabilities. Okay, sorry for that. Let's say the payables are liabilities, and if liabilities are reducing, then we are going to debit them. All right, so I'll come here and then I'll have 7, transaction 7. The corresponding entry we have agreed that is going to the bank account. That is a matter of judgment. You can also decide to put it under the cash column, all right? But you have to ask yourself, how much cash do you have, so that you can be able to pay this amount from it, all right? So the amount involved here is 3,000. So it's a matter of judgment. You can decide to put it use the cash to pay your suppliers, all right? But we are assuming here that it is bank. So I'll go to my bank, and our bank has reduced, all right? So we have actually paid money from our bank. Therefore, we are going to credit it in the name of payables. Now, another name for payables are creditors, and another name for our receivables are debtors. All right, so take note of that. So in some books, you will not see payables, but you see creditors. It is the same thing. All right. Okay, so I think we have recorded everything here as well. So let's go to transaction 8 and see what is there. A payment of 4,000 was received from a customer for some of the sales on credit. So we know we sold on credit, which we recorded in the receivables account, and now they are telling us that these receivables, a customer has paid 4,000. All right, so it means our receivables are going to reduce and our bank is going to increase. Again, we are assuming that this payment was made through the bank. All right, that is the assumption. You can also assume that the payment was made through cash. In this case, instead of recording it under the bank column, you can come and record it under the cash account column and into the cash account. All right. So let's come here and then do that. So our receivables are reducing. Receivables are assets. If they're reducing, they are going to be credited. So I'll come here and then I'll have my 8. The narration is going to be bank. Sorry, that's so it's going to be bank, and the amount involved is 4,000. All right, so quickly I'll come to my bank account. Now my bank is receiving, we are receiving money from a customer. Therefore, the bank account is going to be increased. So I'll come here and write 8, and I'll have receivables. So I have my receivables, and the amounts can be referenced from my receivables account as 4,000 right there. Okay, we continue. So number 9, Donald drew 1,000 from the bank account for his personal use. Okay, so this is another transaction altogether. So Donald took or drew 1,000 from the bank account for his personal use. This is what we call in accounting drawings. We call it drawings. So let me quickly write that here. Okay, so drawings occur when the owner of the business, it usually occurs in one-man businesses or sole proprietorship. Okay, so what happens is that the owner can decide to withdraw money or take goods or inventory from the business for personal use, and so we call these drawings. All right, so we have drawings of cash and then drawings of inventory or goods. So it can come in two ways. In this particular example, they are saying that the drawings that was made was from the bank. Therefore, this is drawings of cash or check, all right, for personal use. So we are going to open a new account called drawings, and then the corresponding account is going to be our bank account, as it is already clear from the transaction. So I'm going to open a new account called drawings account. So I'll come here and write drawings. Let me put my S there, and let me quickly highlight bolding that. Okay, so since we have taken money from the bank is going to be credited because it is reducing. Therefore, our drawings is an expense to the business, is seen as an expense, and therefore, if it is increasing, it's going to be debited. All right, so the drawings is going to be debited, and then our bank account, which has reduced in value, is going to be credited. So I'll come here and write 9, and I'll have bank. Sorry, so I have my bank, and the amount involved is 1000. So quickly I'll scroll to my bank account right here, and it has reduced. Therefore, I'll have 9. I'll have my drawings there, and the amount can be referenced from the drawings account of 1000 there, and then I can hit OK, so that we'll have our 1000 right here. All right, so let's continue. So that is it for drawings as well. Okay, so let me just delete this. Transaction 10, Donald paid $200 for diesel for the motor van. So paying for diesel for your motor van is an expense. Okay, so we can even classify it as a transport expense. All right, and as I said, expenses are made usually to increase the efficiency or the capacity of your assets. Therefore, they are treated in the same way assets are treated. So what we are going to do is that since you have paid for an expense, you are going to open that expense account. And so I'm going to call it, I'm going to call that transport expense. Transport expense account. All right. So I can merge and center that, and also bolding these headings using Control B there. So these are expenses, and we have incurred expenses, or we have paid for expenses, which means our expenses have increased. Therefore, we are going to debit it, as we know from the double entry principles here. Okay, so we see expenses increase in expenses are at the debit side. All right, so when you come here and we are seeing that we have paid $200 for diesel, to buy diesel, that is a transport expense, and we are going to debit it. So I'll come here and write my 10, and I'm going to have the narration. We have paid 200. We are going to assume that we are paying it in using the bank account. Therefore, I'll have my bank, and the amount involved is 2000. Again, we are assuming that the transaction took place uh, using check. All right, because the transaction is silent on which of the whether it was paid, the payment for the diesel was made by cash or by check. But since most of our transactions are being made from our bank account, we assume that we are paying that using check. All right, so that is it, and the corresponding entry is going into our bank account. Our bank account has reduced, therefore is going to be credited. So I'll have transport. So I'll have transport right there. Sorry. So you have transport, and let me add EXP, just EXP there, and the amount can be referenced from the transport expenses account here as 200. All right, so that is it. I hope you understood that one too. Then we have transaction 11. The business paid 1500 by check for the premium on insurance policy. This is also insurance, an expense called insurance. So insurance we know is an expense. The business has insured the owner of the business has insured their business. Therefore, this is an expense you are going to pay in the form of premium, insurance premium. All right. So quickly, I think our accounts have finished. So let me just come here and copy this, copy that, and then I can come down here and paste. And then I can also come here and paste another one here. Okay. So we are going to have an expense called insurance expense, or just insurance. All right, and then let me merge and center that. Okay, now this is an expense and you are paying for the expense. Therefore, increase in this expense is going to be debited, and we are assuming that what did we pay it by? We paid it by check. Therefore, it's going to into the bank account, and the amount involved is 1,500. So quickly, I'll just come here and have my 1,500 there, right here. And then I'll go to my bank account. So this is supposed to be 1,000 right there. So as we can see, because I copied um my drawings account, I duplicated it. Changes that I made to the amount has also reflected here, but that is not supposed to be the case. So I'll come here and reselect the amount 1,000, because the drawings we made were only 1,000. Therefore, I'll come to my drawings account and change this amount to 1,000 right there. Okay. So what I will do is that I'm going to delete this. I'm also going to delete this one. Okay, so that we'll have the amounts right there. Okay, so we know that we have opened an insurance account which has been debited in the name of bank. So I'll come to our bank accounts column here, and then I'm going to write my insurance. Remember, the insurance was debited, therefore our bank account which we are using to pay for the insurance is going to be credited. So I'll come here and I'm going to reference this particular insurance amount right here, which I'm here to enter. So I'll just come here and enter my insurance amount, which is 1,500 right there. Okay, let's see if it has updated in our bank account. So we have 1,500 referring to our insurance. So as you can see, the space for my bank column is not enough. So quickly I can insert a couple of columns here. Rows, sorry. So let me insert, say, 2 rows is okay. Then I can actually extend this a little as well. Okay, so we have that. So as you can see, the transactions we are entering here are very dynamic. Okay, so as you can see with the drawings, when I copied the drawings account and I made a change, it's reflected in our bank account as well. So this, what you are seeing here, is fully automated, and I'm going to teach you how to understand the automation just after we are done entering these transactions. So I'll come here. So let's go to the last transaction and see what is there. The business received a bank loan of 10,000 repayable in 2 years. So as I explained, we have liabilities. All right. Now the bank loan is a liability, but this is a form of non-current liability. And as I said, for non-current items, we open an account in their name. we open an account in their name. Therefore, when you come here, the bank loan is going to have a bank loan account, and then the corresponding entry will go into our bank account because it is a bank loan. And so, taking the loan, we are going to receive it into our bank account. All right. So, since bank account is receiving or is increasing, we are going to debit our bank account, and the loan here is a liability and it is also increasing because we are receiving loan. It is increasing. Therefore, we are going to credit our bank loan account. So that's the last account we are going to open. So I'll scroll down to my last account here, which was a duplicate. So I'll have what we call bank. Sorry. So I have bank loan. So let me merge and center that. And as we rightly said, the bank loan is a liability. Therefore, if we take a loan, it is increasing, and so we have to debit and credit it. Sorry. So we'll have our credit there, and the corresponding entry is going to our bank account. Therefore, I have my bank there, and the amount is 10,000. The amount is 10,000. So quickly, I'll go to my bank account, which has actually received a fresh loan. So our bank amount has increased. Therefore, I'll have my bank loan here, and I'm going to reference the amount from my bank loan account. All right, so just like that, we just entered each of these transactions into the books of Donald. All right, into the books of Donald. So that is how we prepare the various accounts within the ledgers in the um, the cash book, and sorry, in an Excel worksheet. Now, what you can do is that you can classify these items under the heading General Ledger. So what you can do is that you can just rename the sheet as um, ledgers, all right, or ledger. You can just do it ledger accounts. All right, so you can name it ledger accounts right there. So to do that, I just double clicked the sheet name, and then I can change the name of the sheet. Okay, now that we have done all of these, the next thing we do is that we do what we call balancing off of the accounts. We balance off the accounts. Now, as I said, in accounting, we are always trying to ensure that this basic accounting equation is always at play and it is always being satisfied. The assets are always being equal to our equity plus liabilities. That means that, as we understood, the debit side is always equal to the credit side. All right, the debit side must always be equal to the credit side. Now, when you look at the accounts, that is not what we are seeing here. So we are going to make it agree with each other. All right, we are going to make them agree with each other. So what we do is that to balance off an accounting, what we do is that the first step is for us to calculate the total for both sides. So we'll calculate the total for our debit column, and we are talking about the amount columns only. Okay, so we are going to calculate the total amounts of the debit side, and we are going to calculate the total amount for the credit side. Then we are going to use the side with the highest total as the total for both sides. Now, the first account here is equity. So let's use equity as an example. So we have equity accounts. The equity account here has 50,000 at the credit side and nothing at the debit side, which means that between nothing and 50,000, 50,000 is the highest. Therefore, this 50,000 becomes the total for both sides, both the debit and then the credit sides. All right, that is what we are saying. So the first step, calculate the two totals, which we found to be 0 and 50,000. 50,000 is the highest, therefore it's going to be the total for both sides of the accounts. So I will come here and then I'll have alt equals, and that is the shortcut for total in Excel. Alright, since it's one transaction, it's going to reference the same number there as 50,000. And then I'll come to the corresponding side, which is the debit side, and I'm going to reference this same total here. And always make sure that they are on the same line. Alright, make sure that they are on the same line as we have here. And then what I'm going to do is to insert a border. So Alt H B, and I'm going to insert the top and double bottom border. Okay, the top and double bottom border, which is U. So I'll press U and that will do it for me. And then I can just hit F4. I can just hit F4 to repeat that particular action for me. So we have it nicely done. All right. Now there is a border here which I want to remove. So quickly let me remove that small border there. All right. Then after doing this, the next step is to now make sure that the two totals are equal. So how do I do that? I would have to insert a figure at the debit side here, so that when I add them together, they are going to give me this total, which is 50,000. And in this case, there is nothing here, which means that the amount that can make it equal to 50 is my 50,000. So I'll just type in 50,000 right here. And this 50,000, which is the difference, okay, between the credit side total and the debit side total, is what we call balance carried down. I'll come again. This 50,000 is the difference between the highest or the higher total and the lower total. Now, the total for this debit column was 0, which is actually dash. And the total for this is 50,000, as we have seen. The difference between the two is going to be 50,000. Therefore, we have put the 50,000 here. All right. So that is it. That is just for explanation. And what we do is that after balance carried down, after carrying down the balance, which is the difference, we will come to the opposite side of the account here, to the opposite side of the balance carried down, and we are coming to input the another one here called balance brought down. Now you can see I'm mentioning balance carried down, but I'm using the lowercase letters C/D. Okay, then I came here and then I wrote balance brought down, but I shortened it B, lowercase letter b /D. So that is an acceptable convention. We call it convention. All right, it is a practice that has come to stay in accounting. All right, so whenever you see this, it is referring to balance brought down, and then whenever you see this, you are referring to balance carried down. All right, now this balance carried down is usually at the end of the month. So as you were using the date, this would have been the ending of the month date. It would have carried the ending of the month date, and this will be the next month date, first date of the next month. So this is usually first, and this is usually the end of the month date. So it can be 31st, it can be 30th, or it can be 29th or 28th. All right, depending on the month and then the year. And this one is always first of the following month. So what I'm saying is that, assuming this is 31st January 2024, Then this would be 1st February, which is 2024, like that. All right, so that is what we do. Okay, that is what we do. But in this particular case, we do not have dates have not been given to us, and the month is also not known. Therefore, we will not enter anything. But that is how it is done. All right. So this balance brought down will be equal to the balance carried down amount. Now, the reason why we have balance carried down or balance brought down, I'm going to tell you in a jiffy. All right, you are going to find out in a jiffy. So relax. Now, what you must know is that the balance carried down can also be referred to as balance carried forward, and the balance brought down can also be known as balance brought forward. So in that case, it's going to be balance C forward slash F for balance carried forward, and balance B forward slash F, which is balance carried forward. All right. So always be consistent. If you use balance carried down here, then it should be balance brought down on the opposite side. If it's balance carried forward, then it should be balance carried forward on the opposite side as well. All right, but the common one is what I'm telling you is the balance carried down and balance carried forward and balance brought down. All right, so this is a single transaction account, so it is kind of easier. So let's come to a more complex an account that has more than one transactions, and then we'll see how you're going to do that for better explanation. So when we come here, the first step, as you said, is that you are going to calculate the totals for both sides. So I can just come here and do alt equals, and that's going to sum everything for me. So I have 14,700. I'll also come here. This is just for me to know the total for both sides. So alt equals, and that will give me the totals. Now from here, I know that the debit side is 64,000 and the credit side is 14,700. Therefore, we can conclude that this 64,000 is higher, which is the debit side. Therefore, this 64,000 becomes the total for both sides of the account. So what I'll do is that I'll just come here and reference this 64,000 right here. Okay, so that becomes the total for both sides. Then, as I said, you are going to double underline that. So I'll come here and I'll select top and bottom double bottom border right here. I'll come here and repeat it using F4. Okay. That line has cleaned there, so let me just, okay. So we have this. All right. Now that we have that, we are going to ensure that the totals are now equal. Okay, so what do I do? This is the side with the lower total. So I'm going to make sure that all of these amount is equal to 64,000. So what I'll do is that I'll just come here and write equals and select my total and subtract it from the sum. Okay, so I'll write sum of all of these amounts here, close my parentheses. Okay, so what did I do? I just pick the total. I want to ensure that all the amounts here is equal to 64,000. And since you have calculated the total here and it is not up to 64,000, we are making it to be 64,000 by inserting a particular figure here that is going to make that when added to the sum of these figures is going to give you 64,000. That's why I've picked the 64,000 here, and I'm going to subtract the sum of these amounts so that the difference when added to the sum of these already existing amounts will be equal to 64,000. And we are going to call this amount balance carried. So sorry for, so we have, it's going to be balance carried, so balance forward slash D carried down there. All right, so that when I come here and I do alt equals, which is now summing everything for me, I'll still have my 64,000. So this is circular reference issue. So let me just cancel that. So I'll just undo that. But what you are saying is that assuming I come down here, I want to verify whether this total amount here is adding up to 64,000. I'll just come to the down here, and then I'll write equals sum. Sorry. So I just come here and write equals sum, and I'm going to add everything, select everything here, and click enter. And that gives me 64,000, which means our balancing here, the balancing figure here is correct. So what we just did is that we calculated this total and we found it to be, which we can find here as sum, 14,700. Okay, and want to insert a figure which when added to the 14,700 will give us 64,000. That is why we subtracted the sum, which is 14,700, from the total sum, which is 64,000. All right, then I'll come here and I'll have my balance brought down, balance BD, and I'm going to reference this amount here, balance carried down. Okay, so as simple as that. All right, as simple as that. So we are going to do this for all of the items. Now I'm going to leave the account with only a one transaction or a single transaction for you to complete. So you are going to apply this particular basic um, balancing, which we did in the first one, to the single transaction accounts. All right, so that we can complete the other ones on our own. So to enhance your understanding, let's do this together, and then I'll leave the rest for you to practice. All right, so this is 0. Therefore, the total is what? 6,000, which I can actually use alt equals and sum that, and then I can come here and reference the 6,000 here, and that's going to be the total for both sides. So I'll just come here and select my top and bottom, that, select here and select that, and now I'm going to make the lower side equal to the 6,000 by inserting a balance called balance carried down, and I'm going to reference this total right there. Okay, so that when I add this, it's going to give me the 6,000 here, and then this balance carried down is going to be brought down as balance BD, and I'm going to reference the balance carried down here as well. Okay, so as simple as that. So you can do the rest now. So the single account transactions. All right. So don't forget I will leave a link to download the question or the scenario in the video description so you can follow along. All right. Okay, so let's come to our purchases. So the first step, calculate the total for both sides. So the total here is going to be equal to alt equals, we have that, and this is empty, therefore automatically the total is going to be this total here, and I'm going to insert my borders, insert my border, and then I'll have my balance carried down, and that is going to be equal to the total here, so that when I add these, it's going to give me 13,000, and then I'll come here and have my balance brought down. As I said, the reason why you are having balance brought down and all those things, I'm going to explain to you. You are going to understand in a jiffy. All right. So I'll reference this and then have that. Okay, so this is a single transaction for the cash, so try that on your own using what we have previously done. Okay, then we'll come here as well and have my alt equals and add that. I'll also come here and reference this total since this is 0, and I'll have balance. So I have my balance carried down, and that is going to be referencing this total, and I'll have my balance. Sorry, so I'll have my balance. Remember, the balance carried downs and the balance brought down, the narration is written under the narration column. All right, it's written under the narration column, so take note of that, and that will be equal to this amount here. Let me insert my borders for the totals like that. Okay, so we move on. We come to our payables as well, and we are going to have that. So I'll have uh, the total here. So this is the total for the credit side, and this is the total for the debit side. The credit side is more than the debit side. So I know that I'm going to insert a balance carried down here. So quickly, the balance carried down will come to the side with the lower total. It's always like that. And then I'll have my total now, which should be equal to, sorry, alt equals. So I'll come here and have my alt equals and hit that. And I'll come here and reference that. And now what's the balance carried down? First of all, let me insert my border for the totals. Now, what's the balance carried down? It is going to be equal to the difference between the totals. So what's the total? This is the total, and I'm going to select the 3,000, which is the total for the debit side, and this is the difference of 7,000. All right. Then I'll come here and write my balance BD, and that is going to be referencing this 7,000 right here. Okay, we move on. We come to receivables. The same thing we did here is going to apply here. So the total is going to be 8,000. So I'll just come here and have alt equals 8,000. I'll come here and reference my 8,000 and underline them using my borders. Then this is where our balance carried down is going to be. So I have my balance carried down, and that is going to be the difference between the total and the lower total, which is 4,000. All right, and then I'll come here and have my balance brought, sorry, so I have my balance brought down, and that is going to be referencing my balance carried down as 4,000. Okay, so these are single item transactions like that, like that, like that. All right, so we are done with the balancing of the accounts. Everything here, I want you to go and do it yourself. All right, now remember that because these are single item transactions, or they are accounts containing only one transaction, if you balance the accounts, the balance brought down is always at the side with a higher total. Therefore, the balance brought down, I want to explain this because of where we are going next. Okay, the balance brought down will always come under the side with the higher total. Okay, the higher total. So since here is 0, this is going to be the balance brought down, and it's going to be at this side. All right, this is what I mean. When you come to the motor van, the amount we had was 6,000 only here. We balance the account, and the balance brought down still falls under the debit side, and it's still 6,000. Okay, that's what I'm talking about. When you come to equity account, it's the same thing. This is what we had in the account originally. We balanced it, and still the balance brought down comes with the same amount under the same column or under the same side, which is the credit side. So that's what I'm talking about. Now, after balancing off your accounts, we extract what we call the trial balance. So I'll come here and write trial balance. So I have my trial balance, and it is prepared as at the end of the particular month or period which we are preparing the account. So since we don't know that in this particular scenario, I'll just put dash dash dot there. So we have trial balance as at. And what is a trial balance? The trial balance is simply the list of all the account balances, a list of all the accounts and their balances. All right, is the list of all the accounts and their balances. So, why do we prepare the trial balance? There are fundamentally the trial balance is meant to summarize whatever we have done in the ledgers or the books of accounts. All right, it's meant to summarize the accounts we have opened, and then two, it helps us to identify or to determine the arithmetic accuracy, the arithmetical accuracy of the entries we have made within our accounts. Okay, so that is the purpose for extracting the trial balance. And then thirdly, the trial balance also serves as a basis for preparing the financial statements. So it is from the trial balance that we prepare the financial statements of the company. All right. So you see how the entire thing went. Now, first of all, you need to understand that even before you prepare these accounts, you need to prepare what we call the journals or the day books. But thanks to automation, accounting softwares now generate our day books for us. All right. So all that you have to do is that because they are going to generate invoices and receipts for you, they are going to be input into our day books. So you will have everything done by the accounting software. So all you have to do is to make sure that you understand these account opening systems for you to be able to extract your trial balance and prepare your financial statement. That is why we didn't start from the day books. All right, those things are now fully automated. All right, so as I said, the trial balance is a list of all the accounts and their balances. So what we are going to do is that we are going to list all the accounts we have opened here with their balances. Now, to achieve that, the trial balance has columns. All right, it has columns. So the first column is the particulars. We call it particulars, and it has a debit column. As I said, in accounting, the debit is shortened as DR, or what we call doctor, and then the credit is also CR, like that. All right, so you have particulars column, you have debit column, and then you have credit column. So what we are saying is that you will have the name of the account here under the particulars column, and then these debit and credit columns are going to be containing the amounts that are our balances brought down. The balances brought down. That is why we are having balances brought down and balance carried down like that. Okay, so the amounts you are going to be seeing under these two columns, which is the debit and the credit, are going to be the balances brought down. The balances that we have brought down. Okay, so first of all, let's go. We have equity. We are going to list all the accounts we have opened. And so we have equity, we have bank, we had motor, van, we had purchases, we had sales, we had payables, we had receivables, sorry, we had cash, what again? So let me actually select everything here, and I want to put it like this rather. Okay, so we had cash, and what again do we have there? We have drawings, we have transport, we have insurance, and then we have bank loan. So we have drawings, we have transport, we have our transport, we had um insurance, we had insurance, sorry, and then we have bank loan. I hope that is all. I hope that is all. All right. So what you're coming to do is that depending on where the balance carried down, or the balance brought down falls, is going to be put at the debit or the credit side here. Okay, so let's look at equity. Where does our balance brought down falls? In the equity section. This falls under the credit side. So wherever the balance brought down falls, we refer to that account by the side on which the balance falls. So since equity balance brought down falls under the credit side, we always say that equity has a credit balance. Okay, equity has a credit balance. Okay, now let's see our bank. The balance brought down falls under the debit side. Therefore, we can say that our bank has a debit balance. Okay, now what you should know is that from the accounting equation again, assets are found on the left side of the account, therefore, and they are found on the debit side of the account, therefore, they have a debit balance. Okay, so when um the same thing applies to our equity and liabilities. Okay, the liabilities are found on the credit side of the equation, or at the right side of the equation. Therefore, they have a credit balance. That is what you are saying. Okay, so the equity has a debit balance and a credit balance here. So what I'll do is that I'll quickly go to my credits column here under the trial balance, and then I'll reference my balance brought down from here, 50,000. Okay, then we know that the bank is an asset, therefore it should have a debit balance. Therefore, I'll come to my bank and reference this particular amount here, which is the balance brought down. So we are going to use the balances brought downs only in the trial balance. Okay, then we have our motor van is an asset, therefore it should have a debit balance. So let's go to motor van account and pick our balance brought down here. Let's go to our purchases. Purchases is also a debit balance account. Okay, so you should have a debit balance there. Then our sales is an income, therefore it should have a credit balance. Okay, if you are new to this, you might be wondering, why is it credit or debit? But we understand that it is debit because that is where the balance brought down falls. It is credit because that is where the balance brought down falls. Okay, but I know this because I've been doing this for quite a number of years now, so I'm used to it. Okay, so don't worry if you are new to it. Don't worry, you get used to it by practice. Okay, you have to practice this for you to be able to understand it even more. So we go to our sales account, and then I'm going to pick my balance brought down here, which I've made a mistake. So this should be B and not C. Okay, so we have that. The next item is our payables. Payables should also have a credit balance. So where is our payables? We have it there at the credit. side right there. So I'll hit enter. Then our receivables is the opposite of payables, therefore it should have a debit balance. So this is our debit balance here. As you can see from here, debit balance. So I'll hit enter. Then the next item here is cash. Cash is an asset and so should have a debit balance. So if you balance this correctly, you should have the balance brought down as this 5,000 at the debit side if you balance it correctly. Okay. The drawings is also an expense account and therefore should have a debit balance. So if you balance it correctly, it should have 1,000 as balance brought down at the debit side here. Transport is an expense, therefore, if balanced correctly, it should have a balance brought down $200 at the debit side of the account. Insurance is an expense, therefore, if balanced correctly, should also produce the same result. Now, bank loan is a credit, is a liability, therefore, it should have a credit balance. So, if balanced correctly, it should have a balance brought down at the credit side of the account. So, I think that is all. So as I said, the trial balance tests the arithmetical accuracy of the various entries within our cash. So at the end of the day, the total for the debit should be equal to the total for the credit. So when we add everything under the debit column, it should be equal to everything, the sum of the items or the entries in the credit column. So let's verify that. So hitting Alt equals, I've selected that, but I know that I want to select more than that. So quickly, let me use my arrow keys. So holding, pressing and holding my shift, I can use my top arrow or my up arrow to select everything here and hit enter. And that gives me 80,000. I can just copy this across using Control R and that gives me 80,000. This means that arithmetically, that is very important. Arithmetically, our entries within our accounts are accurate. Okay, they are accurate. So let me just insert that. So it means that the entries we have made in our accounts are arithmetically accurate and that we have followed the basic principle of double entry, all right, in recording the transactions within the account. Now the trial balance, the fact that your trial balance balances doesn't mean that there are no errors in the accounts. Okay, there are errors that are not revealed by the trial balance. There are errors that are not revealed by the trial balance, and there are some that are revealed by the trial balance where you have casting errors. That is, your additions are wrong, where you insert, as I said, the double entry says that when you have a debit entry, you should have a corresponding entry and credit entry. Okay, so when you debit only and you do not credit, the trial balance will not balance. Okay, or when you enter your credit transaction but not the corresponding debit entry, it is going to be reviewed by the trial balance, and so your trial balance will not balance. Okay, those are what we call single um, entry errors, single entry errors. So the trial balance revealed casting errors, which is additions in your account, as well as single entry errors. Okay, so those basic errors are reviewed by the trial balance, but there are some errors that are not reviewed by the trial balance. An example of such error is where you enter a wrong figure. Assuming I make this 1,000, it's going to reflect in the corresponding entry to as 1,000. So what's the corresponding entry? Is going to be the bank account. So it's going to um, produce 1,000 also in the bank account, which is an error because the amount involved is actually 1,500. But if I input 1,000, the account will still balance, but I figure I've put the is wrong. So that's such an example of an error that is not revealed by the trial balance, and we call it error of original entry. Okay, there are so many errors that are not revealed by the trial balance. So on that note, if you are interested in learning more about correction of errors in accounting, leave the comments a comment in the comment section, and I'll be glad to respond to you. All right. Now, one final thing I want us to do here. Now, you see that some of the figures we entered were hard coded. What do I mean by that? It means we entered them manually. So, for example, this particular amount, and some of them were referenced. So, this is a referenced amount. Okay, as you can see here, it was referenced from this one. So, how do we know that these ones are hard coded and then these ones are referenced? So we can do that using the go to special function. So I'll go to F5. So you just hit F5 on your keyboard, and that opens the go to window here. It opens the go to window for you. And what we'll go do is that we'll go to special, and I'm going to select constants, with the exception of texts, logicals, and errors. So I want you to select all the constants that are numbers within my worksheet for me. So I'll hit OK. And so it has selected all the constants, although the transaction numbers have also been selected for me. We are not interested in those ones, but just for illustrative purposes, it has selected all the amounts that we have entered manually, as you can see. So to differentiate those ones from the references, so that in case we want to make any changes to our figures or to our transactions, we will change these ones rather than the referenced ones. We are going to change the font color. So I'll come here and I'm going to change the font color to this blue. That is what we usually do in financial modeling as well. So that in case the amount I have input in um my equity, the amount introduced into the business changes to say 100,000, I will rather change the one illustrated in blue, so that it will change the referenced one and ultimately change the figure within my trial balance. Okay, so this is equity 50,000. This is T8. It's referencing T8. All right, so because we didn't automate this, the balance carried down is supposed to be equal to the total. All right, so since I've changed that, the color should change to black. Okay, so when you change that, the trial balance should also balance automatically. All right, so that is how we do it. That is how we do everything here. So all that you are seeing here is that whenever I want to change anything here, I'll change the blue figures, and then everything changes dynamically. Okay, so let me just send my figure back to 50,000, the original 50,000, and it changes back to the 50,000 as reviewed by the trial balance here. So this is how we um prepare the various accounts in Excel, and also um, um, input some automating functions to make our entries very, very dynamic and automated. All right, I hope you've learned a lot in this video. In the next video, so after extracting your trial balance, the next thing is to prepare your financial statements. Okay, but this trial balance is too small, or it doesn't contain enough information for us to prepare a full set of financial statements. Therefore, I've gotten another trial balance here. As you can see, this is a more comprehensive one. Okay, this is a more comprehensive one, and it also has some additional information at the end of the period that we are going to use to adjust the figures within the trial balance to prepare a full set of financial statements. And we are going to do that in the next video. So thank you very much for your time in this video. I hope you learned a lot. This is how you automate accounting processes within Microsoft Excel. And please, if you have not subscribed to the channel, please make sure you have subscribed, and also consider hitting the like button, sharing the video, and leaving your comments in the comment section. I'm very much interested in that. So I'll see you in the next video. Until then, it's a bye for now.